When it comes to investing, analyzing financial statement information, ratios is one of the most important elements of fundamental analysis process. At the same time, the massive amount of numbers in a company's financial statements can be bewildering and intimidating to many investors. However, through financial ratio analysis, you will be able to work with these numbers in an organized fashion. Financial ratios are usually classified on a basis of function, liquidity, solvency, profitability, activity, capital market ratios. Today, we're going to talk about solvency ratios. Presentation was made by Ali Jamalı, Batarhan Idrisov, and Karina Milkumiyans. The company that we're going to analyze is Dutch Lufthansa, commonly known as Lufthansa, the largest German airline, and when it combined with its subsidiaries, also the largest airline in Europe, both in terms of fleet size and passengers carried during 2017. On the left side of the slide, we can see the key financial data for Lufthansa. Before we start solvency ratios, we should analyze balance sheet and income statement respectively. Solvency ratio is a key metric used to measure an enterprise's ability to meet its debt and other obligations. The solvency ratio indicates whether a company's cash flow is sufficient to meet its short-term and long-term liabilities. The lower the company's solvency ratio, the greater the probability that it will default on its debt obligations. Solvency is defined by two types of ratios, debt ratio and coverage ratios. A company's debt ratio is the ratio of total debt to total assets. Total debt includes both short-term and long-term debt. There are several debt ratios which gives users a general idea of the company's overall debt load, as well as a mix of equity and debt. Debt ratios can be used to determine the overall level of financial risk a company and its shareholders face. In general, the greater the amount of debt held by a company, the greater the potential level of financial risk the company could face, including bankruptcy. Three main types of ratios exist. We can observe them on the left side of the slide. The formula for total debt to asset ratio equals to total debt divided by total assets. So for our project, for all years subsequent to 2013, we took the figures in the cells 51 plus 43, which stand for current and non-current liabilities, and together make a figure of total debt, and divided them by total assets, which is cells with number 25. The numbers that we have calculated are as follows, starting from 0.79 to 0.86. If we transfer these numbers into percentage, it means that approximately 80% of all assets each year, except for 2014, where these numbers equals to 86, are financed by debt, and only 20 to 14 of asset is financed by equity. So indebtedness of a company is rather high. Normal figures would be around 50 to 70%. Next, debt to equity ratio equals to total debt divided by total equity. The numbers that we have calculated vary from 3.76 to 6.55, meaning that debt portion in a capital structure plays a major role. Moving on to debt to capital ratio, the formula equals to total debt divided by total capital. The ratio measures a company's capital structure, financial solvency, and a degree of leverage at a particular point in time. Coverage ratios. The coverage ratio is a measure of a company's ability to meet its financial obligations. In broad terms, the higher the coverage ratio, the better the ability of enterprise to fulfill its obligations to its lenders. Times interest earned. Let me show you in an example. For example, let's assume that the ratio is equals to 3. So what does it mean? It means that every dollar of interest cost is covered by $3 of operating profit. The higher the value, the stronger the solvency, widely followed by borrowing banks. Recommended values vary from 3 to 5. As we can see, our company is doing well year to year, increasing its efficiency in covering profit by interest. So then, fixed charge coverage equals to EBIT plus lease payments divided by interest expense plus also lease payments. The fixed charge coverage ratio measures a firm's ability to satisfy fixed charges such as interest expense and lease expense. And the last one, coverage by fixed asset resources by long-term resources. It equals to long-term resources divided by fixed assets, long-term resources. Coverage of fixed asset by long-term resources equal to 1. For example, what does it mean? Fixed assets are 100% covered by equity and long-term debt. Company follows the general rule that its operating assets should be covered by long-term sources. Ratio higher than 1 means long-term resources cover also part of current assets. But when it comes to lower than 1, it means long-term assets are partly covered by short-term debt. It means risky.